Will student loan debt prevent me from getting a mortgage? It's no secret that student loan debt is a huge thing that's plaguing the US. But will that stop me from getting a mortgage? Be sure to watch this video to find out. In this episode, we're going to talk about the pre-approval process for getting a mortgage. Then we're going to discuss student loans and how they can potentially kill this opportunity for you. After that, we're going to discuss new guidelines that recently went into effect that can potentially change everything. All right, let's get to it. Okay, so what is the pre-approval process for a mortgage? The first step is, of course, that you're going to have intact credit. And for the most part, what mortgage lenders are looking at is they want you to have a mortgage mid-score of 620 or above. You also need to have solid work history for the past 2 years. Now, in terms of solid work history, as long as you're in the same industry, you are allowed to change jobs. A lot of people think they can't change jobs for the last 2 years, but that's just not true. If you took another job making the same money or more money, and it's in the same industry, the lender's not going to care. What the lender does care is if you pick up a side hustle or a secondary job, and you haven't had that job for at least 2 years, then they're not going to be able to use that income. Where some issues also come into play as far as income is concerned is if you own your own business. If you own your own business and you don't pay yourself as a W-2 employee, then they're going to want to see 2 years of tax returns. And in many cases, that can be problematic, depending upon what your top line looks like and your bottom line looks like. Okay, so let's say you have qualifying scores and you have solid work history, at least you think you have those things intact, then it's time to find a lender. My recommendation, and you'll hear me talk about this all the time, is to find yourself a broker as opposed to a financial institution. I'm a fan of mortgage brokers. They have a lot more products. They have a lot more access to products. In many cases, they can get you qualified in a much easier fashion. They have more competitive rates. In many cases, their fee structures in many cases are more competitive. I'm not saying don't go with the financial institution. I'm not saying that at all. I'm just saying that if you have problem credit or credit challenges or you're right on that line of 620, it may be best for you to try to find a mortgage lender that's actually a broker to help you with all the different programs that are out there. Okay, so just know that when the lender pulls your credit, if they pull qualifying scores, they're going to run your file through what's known as AUS, or an automated underwriting system. If they get an approval, they're going to ask for all of your verification documents. They're going to want W-2s. They're going to want tax returns. They may even need bank statements and other financial data. The important thing here is full disclosure. Once they get this all together and they verify not only that you've got pushed through AUS, but then also they can verify your income, they're going to push out a pre-approval. And then it's time to go find a realtor with that piece of paper that says that you're worthy to buy. Okay, but what about those with a huge amount of student loan debt? It is true that a huge amount of student loan debt can easily kill your opportunity for a mortgage. Until recently, and we'll get to this at the end of this video, there wasn't a real opportunity for people that had lower incomes and a huge amount of student loan debt to actually purchase. Now, when you go to your lender, they're going to work up your ability to purchase, and they're going to use what are called debt-to-income ratios, or DTI ratios. In general, these ratios need to range between, and it widely depends on the lender and the loan program, but we're going to say 43 to 50% as an example. Now, a debt-to-income ratio depends on if it's a front-end or a back-end ratio, but we're going to talk just in general, is going to be how much house that you can afford with principal, interest, taxes, and insurance. It's also going to include your credit card debt that's listed on your credit report, your auto loan debt that's listed on your credit report, and it's also going to include your personal loan debt that's on your credit report. So basically anything that's on your credit report. Your debt-to-income ratio also includes your overall student loan debt. We're going to talk more about the debt-to-income ratio in a later video, so I don't want to get too much into that because that's a whole discussion in and of itself. Okay, now let's kind of run through a scenario where student loan debt could actually kill a mortgage loan. Let's say that we have a teacher as an example. Let's say that teacher makes $50,000 a year as a teacher, which is a pretty common income for a teacher. Let's say that teacher has $100,000 worth of student loan debt, or in some cases they have a lot more. I see a lot of debt when it comes to educators. Let's say they have $100,000 worth of debt. In most cases, that teacher would be on some kind of income-based repayment plan or potentially some kind of public forgiveness program or some type of student loan forgiveness programs. What it means is that the loan is not going to fully amortize over the life of the loan. And that puts us in a situation to where the lender used to have to take 1% of the overall student loan. So if you had a $100,000 student loan, 1% is what they'd have to take. That would be $1,000, and they would reduce your overall ability to purchase. So back to this scenario of $50,000, if you have to deduct $1,000 from what they would have been able to purchase, that could be a situation where they're just not able to purchase anything at that point. So what we found ourselves in is that people took on a tremendous amount of student loan debt, and in many cases, some of the people that serve us the best, like teachers, are not able to purchase homes because their debt-to-income ratios are too high. And what this does for me, and what it makes me feel like, is that this is a terrible, terrible situation for people that serve our children. They take a lower than average yearly pay structure to serve us, our community, and our kids. They went to school and took on a tremendous amount of debt to get that master's degree so they could get a few $1,000s more, and now they're unable to purchase a home because they took on too much debt to serve us, which is the craziest thing. So there's a lot of other people that have done this same type of thing, and things are changing for them now. We're getting ready to get into that. But before I tell you about the new changes that came about just recently that are allowing more people to purchase, please like this video and subscribe to my channel. I'll be working hard to bring you a new video each weekday over credit, lending, real estate, and other personal finance topics. Okay, so now new guidelines that recently went into play for people that have student loan debt, and I'm really excited about this. In fact, when this new guideline changed last year, I wrote a blog about it, I pushed it out on social media. I was super excited because it's gonna open up the dream of home ownership to a ton of people who have a lot of student loan debt. The thing that changed mostly is that instead of taking that 1%, if the student loan doesn't fully amortize over the life of the loan, the guidelines have changed so that they can take whatever payment is on that student loan. As an example, if we've got a teacher, let's say she's got her master's degree, she's got $150,000 worth of student loan debt, she is going for the student loan forgiveness program, which means she's gonna try to pay, or he's gonna try to pay as little as he can on that student loans for the next 10 years, and it'll be forgiven. Whatever stated payment is on the credit report is what they can take. And if that stated payment is zero, but the teacher is actually on an income-based repayment plan where they're actually paying $50 a month, then they can take that $50 a month. Without getting too confusing, let's take that same teacher that has the $150,000 worth of student loans previously with the $50 stated payment. They would have to take $1,500 and reduce their debt-to-income ratio, which would oust that teacher from being able to buy a home. Now they can take the actual $50 payment. That is huge. So if you've got a tremendous amount of student loan debt, don't think that you can't make a purchase because things have changed. The other part of this change is that let's say that you're actually on a $0 payment. You're in deferment or forbearance on your student loans. Instead of taking the 1%, now they take 5%. And that's only if you have a zero payment. So if you've got $150,000 worth of student loans, instead of taking $1,500, they're going to take half of that, which is $750, and that will reduce your overall ability to purchase. So what I do for a vast majority of my clients that are in this situation is that we're going to have that discussion on how to restructure their student loans, at least temporarily. If they're sitting on a zero payment and they've got $50,000, $80,000, $100,000 worth of student loan debt, instead of getting hit with that 0.5%, they can be put on an income-based repayment plan or some other repayment plan. All student loan service providers have these plans, and get an actual stated payment for either a month or two while they're trying to make a purchase. That way they can take that stated payment instead of the bigger payment. There's a ton of companies out there that will charge hundreds and even thousands of dollars to help you restructure your student loans. No, this is absolutely not necessary. The government has a website set up. You can call your student loan service provider. There's lots of ways to restructure your student loans and also understand the different ways to restructure them with your current loan student service provider. You don't have to pay somebody thousands of dollars to do that for you.